Hello, good evening everyone. Today we are going to start FR regular batch. So first we'll go through the syllabus. Okay. So your institute has made minor changes in the syllabus. They have removed 2 topics. They have added 2 topics. Remaining syllabus is the same. Plus in the new syllabus you will have to also study MCQs. For old course MCQs are not there. So old course student can enjoy, they don't have to study the MCQ. So if you look at the objective of this FR syllabus, this is taken from the institute website only, that you have to understand the application of Indian accounting standard. So the focus of the syllabus would be Indian accounting standard, which in short we call it as Ind AS. That is the Indian version of IFRS. Indian version of IFRS is Ind AS. And by studying this syllabus, you will be able to understand how to apply Ind AS in the practical scenarios, and it will be very much useful for you after you qualify, because more and more companies will come under Ind AS. More and more companies will follow Ind AS. Not only the companies which are listed are supposed to follow Ind AS. Not only companies which have net worth above 250 crores are required to follow Ind AS, but their subsidiary companies, associate companies, joint venture companies, partnership firm, they will also follow Ind AS. So the number of companies which are going to follow Ind AS will be more and more. When you go for the interview, you will be asked questions on Ind AS. Nowadays I find that the interviewer usually asks question on Ind AS and not much question on accounting standard, which you have studied in the intermediate syllabus. So what they have done this time in the new course, they have also written in point number D that you have to also develop understanding of certain accounting standard and solve problems in practical scenario where treatment is different in both the standards. So some knowledge of accounting standard will be required in some particular topics. You don't have to study all accounting standard. You have to study only few accounting standards, which I am going to tell you. So this is our syllabus. The syllabus is, first part of the syllabus is Introduction to General Purpose Financial Statement as per Ind AS. So which will first cover the applicability of Ind AS and the division 2 of Ind AS. These 2 topics we are going to start today and tomorrow. Then after that there is a theory topic which is Conceptual Framework for Financial Reporting. Conceptual Framework for Financial Reporting. Then we have Ind AS. Which are the Ind AS applicable to you? Ind AS 1, Ind AS 34, Ind AS 7. This Ind AS deals with basically presentation aspect. Then there are some Ind AS which deal with measurement of based on accounting policies. Here we have Ind AS 8, Ind AS 10 and Ind AS 113. Then there is one very big standard on revenue, and that is Ind AS 115, which is very different from your old accounting standard 9. There are many Ind AS dealing with assets and liabilities. Ind AS 2, Ind AS 16, Ind AS 116, Ind AS 23, Ind AS 36 impairment, Ind AS 38 intangible, Ind AS 40 investment property, Ind AS 105 non-current asset held for sale and discontinued operation, Ind AS 19 employee benefit, and Ind AS 37 provision, contingent liabilities and contingent assets. So long list of standard on assets and liability. Then Ind AS on items impacting the financial statement, like Ind AS 12, which is income tax, but not the direct taxes which you learn. It is how to do the accounting of income tax in the books of account and their presentation. Ind AS 21, your favorite standard of intermediate AS 11 you have studied effect of changes in foreign exchange rate. Then there are some standards which are only dealing with disclosures. Good news, they are very easy. Ind AS 24, related party disclosure. Ind AS 33, earnings per share. But this time the earning per share will be little difficult because you have to also calculate EPS of a consolidated financial statement. And Ind AS 108, which is dealing with operating segments. Very easy, like segment report. Then we have other Ind AS. Ind AS 20, government grant. Ind AS 102, share based payment. Ind AS 41, agriculture. And then we have 3 standards dealing with financial instrument. Very lengthy, very complicated, and that is the area where you need to have lot of expertise, because every company will have financial instrument in their books. Many companies are using derivative products in their books. Okay, so which are these 3 standards? Ind AS 32, Ind AS 109 and Ind AS 107. And the lengthiest part of your syllabus is group accounting, which means consolidation. So here we are going to study business combination Ind AS 103 and then consolidated and separate financial statement. There are 5 standards here: Ind AS 110, Ind AS 111, Ind AS 27, Ind AS 28 and Ind AS 112. So these 5 standard plus business combination together helps you in understanding group accounting like merger, demerger, consolidation, associates, joint ventures. Okay, so we'll take all varieties of situations which are applicable to your syllabus. Then there is one topic which is never asked in the exam: Ind AS, applicability of financial statement as per Ind AS. So here they will be basically guiding you applying Ind AS in practical scenario, which we already cover in the earlier chapters. 2 new topics have been added in the new course, that is ethics with accounting concept, where you have to identify and explain the key ethical issues. Basically, there is a chapter in auditing, professional ethics. Is it there? Yes. That same chapter with some changes have been incorporated in accounts. So I think I will become an audit teacher after that chapter 7. Okay, and maybe I will start one more subjects in future. Yes, auditing. And the last topic they have added is technology and accounting. Technology and accounting, again a theory topic, evolving of accounting in the technological environment. So basically how the new technology, artificial intelligence, machine learning, they are going to affect your accounting also. All of you will become outdated soon. Unnecessarily you are learning, because technology will do all the basic accounting work. Is it right? So therefore you also have to reskill yourself, evolve and learn that technology so that you can survive in future. Otherwise most of the task of an accountant will be taken care of by the technology. So that is what they have explained there. Theory topic, interesting topic. And which 2 topics they have removed from the syllabus? Corporate social responsibility, CSR, they have removed, and integrated reporting. So those 2 are theory topics substituted by 2 topics: ethics and accounting concept, technology and accounting. Is it right? And one bad news for the new course student: you have to also study AS 7. What was AS 7? Anybody? AS 7? AS 7 is your construction contract. Then AS 9, revenue. AS 19, leases. AS 22, accounting for taxation, that is deferred tax accounting. These 4 standard also you have to learn, and you have to compare the accounting under accounting standard and 115. Ind AS 115 is a combination of AS7 and AS9. It covers revenue from other operation and construction contract also. Then Ind AS 116 will be compared with AS 19. They are very different. And similarly, Ind AS 12 deferred taxation is very different from accounting standard 22. So their treatment is different. So they are asking you that you have to study those 4 standards, accounting standard. I repeat, AS7, AS9, AS19 and AS22. These 2 have to be studied so that you can understand what are the changes in the Ind AS. If any new Ind AS amendment announcement takes place, that will also become part of your syllabus in future, that we are going to provide you as and when any amendment happens. So you have to join our YouTube channel AS Foundation, and all the amendments, all new questions that will come in RTP, MTP and exam, that will also be uploaded every 6 months. So whatever is the institute syllabus right now, I have explained it to you. Is it right? This syllabus is quite vast. Considering the time availability, the syllabus is quite vast. So those who are watching on YouTube channel, we will take first 5 days lecture free on YouTube channel, and those who have joined our batch, you can watch the lecture on our app, those who are learning from home, or you can watch first 5 days on YouTube. And those who are attending face to face, they can come to our Pune center located at Prestige Point. You will get the notes, hard copy of the notes. We are going to dispatch the notes one by one, because we are also updating the notes, preparing the notes. We are checking if there is any new question which has been added. In some topics they have added additional questions. In some topics they have not added anything, so it is just same which is appearing in the old course also. So we are going to dispatch the material over a period of time, and we are also going to dispatch one summary chart book which will contain summary of all Ind AS. So one day before the exam you can revise from that summary chart. Is it right? We have also provided to the student who have joined one Telegram link, and they have been added to the WhatsApp group. So we are going to communicate through WhatsApp group and Telegram channel. If you have any query, you can mail to me on my mail ID vinod_ca@yahoo.com, or you can WhatsApp to us on the WhatsApp number 97669 and I will ask you to join the Telegram channel, because you can ask queries to me directly and you will get the response also. Whenever you ask a query, mention the chapter name, number, question number, page number, and if possible take a photograph of the question and the answer, so you'll get the immediate response. If you only write how did you get 255, I can't answer such questions. Okay, so those who have joined live and on YouTube channel, please, now we are going to start our first topic, that is introduction to Ind AS. Okay, those who have taken the admission, we have dispatched you the first chapter PDF, so kindly download and take the printout. In the meantime, you will receive the book, hard copy of the book. We have already couriered the books to you. You will get it in next few days depending upon your location. But in the meantime, you can download the printout of the PDF of chapter 1 provided to you on your email. So tell me, how many of you have received the PDF? Those who have joined the batch, have you received the PDF? Just tell me yes or no. Student can chat on the app by typing your queries, and in case if you want to ask the query, then you have to tell me and I will unmute you and you can ask the query. We can hear your voice also. So have you received the PDF? Have you received the PDF, those who have joined the batch online? So the students have said yes, we have received the PDF. So you can keep the PDF also whatever is appearing on the screen is shared in your PDF also. You don't have to write, you have to focus on understanding. I am sure you will be able to understand. This is a very basic topic and usually they don't ask question on this topic. Usually they don't ask question on, but as a subject Ind AS, we need to understand the background of the subject. Plus in this chapter we will also see the applicability of Ind AS, the legal provisions of Ind AS, and we'll take some case studies to check the applicability of Ind AS. Very important, important for your interview also in future, right? Keep my book with you when you go for interview and revise the basics. You will definitely remember me. Okay, we have simplified your study material. It is not a copy paste of your study material. It is a much simpler version divided into small paragraphs and wherever possible point wise format. Very easy for learning. Okay, so can we start now? Yes. So first we'll see the background of Ind AS. Why Ind AS were introduced in India effective from 1st April 2016. Before that we used to have accounting standard. Sir, whether accounting standards still exist or they have been eliminated? Accounting standards still exist, because I get this question from a lot of people that if Ind AS is applicable, then the accounting standards are not applicable. Accounting standards are still applicable to certain types of companies which we are going to see in this discussion. What happens when every company prepares their financial statements in a different format using different accounting policy? They are not comparable. They are not reliable. You cannot trust them. If they want to raise funds, then you will be reluctant to give them funds. Plus, if an investor wants to invest in a company, he may not understand what is the risk and return. So globally, a thought process is going on that financial statements should be prepared in a standardized manner globally, so that even an Indian company's financial statement can be compared with a Chinese or a Japanese or a UK company financial statement, because now the capital is flowing across the globe. Investors are looking for opportunities in any part of the world, but before they put their money in a company, they need to understand their financial. And if every company, every country follows different standard, it is very difficult for the investor. India realized that. Why the capital is not flowing into our country? One of the reasons was the financial statements were not reliable, not understandable. You may not be aware, but in financial statement there used to be heading like miscellaneous expenditure to the extent not written off or adjusted. And under that we used to have preliminary expense, discount on issue of share. Now foreigners don't understand this kind of heading. Is it right? And if they don't understand, they don't know whether it is good, bad, how does it impact the valuation, etc. So India realized that potential, that if we also make our financial statement of the global standards, of high standard, high quality, then we can attract the investors. With that objective, Ind AS was introduced. So basically to prepare high quality financial statement on which investor will have a trust. And this process started long back. So we'll go as far as 1970. In 1970, Eurozone was formed. That means group of European companies. They came together. As you know, Europe has got many small sized countries. Some countries may have population of 20 lakh, 5 lakh, 50 lakh, 1 crore. In India, on a small area only, a part of the town may have more population than the entire country. Is it right? So instead of having separate standard for each small country, they decided to have a common standard. Hence, for better coordination, Eurozone was formed, and this was the after effect of World War II. Then they formed a committee called IASC, International Accounting Standard Committee, was formed for common standard across Eurozone. So this was the old name of IASB. We will see what is IASB also. This was the old name of IASB. First name was IASC, then they changed it to IASB, and they started issuing standards which were recommendatory, because you can't force standards on different countries. So they are recommendatory, and the numbering system was IAS 1, 2, 3 and till 41 was issued. In between, some standards were deleted also, which were replaced by new standards. So IAS stands for International Accounting Standard. Okay, in India it is also what is that? Indian Administrative Service, but it is International Accounting Standard here, and with that background they started. The numbering was, prefix was IAS, and there was one interpretation committee also. If something is not clear in the standard, it was explained with the help of interpretation, and that committee was called SIC, Standing Interpretation Committee, Standing Interpretation Committee on IAS, so that if any doubt exists, they will clarify that. Just like in India, we also have accounting standard interpretation along with accounting standard. Then in 1983, another eventful year, over a period of time, the cross-border financial scams were increasing. Scam is a part of life. Okay, if you think we can avoid it, you are living in a different world. But we can reduce it. Okay, because data was not given in the financial statement, companies were committing frauds, investors were not aware only what is happening inside the company. So therefore, they thought that now we should have a Capital Market Regulator Association. So SEBI is one capital market regulator. Security Exchange Commission is a capital market regulator. So in different countries, you will have different market regulator. So what they do, they came together and they formed an organization called International Organization for Security Commission. IOSCO was formed. You don't have to remember any of this. I am just giving you the background. And then SEBI is also a member of IOSCO. This IOSCO has almost 90% of the world regulator as a member. So you can understand the importance of this. IOSC asked IASC to make standard mandatory. So now in 1970 it was recommendatory. Then in 1983 the efforts were made to make IAS mandatory, because if it is recommendatory, like our traffic signal, it is recommendatory. What happens on traffic signal if it is recommendatory? Please reply. Nobody follows that. But if you make it mandatory with a policeman standing there and there is a heavy challan, heavy fine, then yes, you will follow it. So that is the reason they started making efforts to make IAS mandatory. So another year which is very important now is the year in which IASB was formed. IASC became IASB now. It was reconstituted. It is called International Accounting Standard Board, and now IASB issues standard which are called IFRS, and the numbering is IFRS 1, IFRS 2, IFRS 3, and till now 17 IFRS have been issued. Does it mean IAS does not exist? IAS also exists. They have taken all the IAS which were in existence, plus now when they issue a standard, it is given a prefix as IFRS 1, IFRS 2 and like this. Okay. So it took over all those standards which were still applicable. So you will find the numbering system is IAS 1, 2, 3, it goes up to 41, but then suddenly it starts from IFRS 1, 2, 3, 4 and up to 17 because IASC issued IAS, IASB is issuing IFRS. Both together is called International Financial Reporting Standard. From time to time the standards are reviewed, amended as per the requirement. So just like our accounting standards gets revised, the frequency of revision is even more in IFRS. And now remember, as the IFRS will change, Ind AS will also change sooner or later. There is not much gap between the change in the Ind AS also. So IFRS is the new version of IAS and it is now widely recognized as global accounting standard. How many countries follow IFRS? More than 150 countries. Globally there are approximately 200 countries, and out of that more than 150 either they have adopted IFRS or they have converged to IFRS. Okay, the numbers keeps changing because some new members will start following IFRS also. So it is now treated as a global accounting standard. The only competition to IFRS is US GAAP, because United States of America, they say no, we will have our own set of standard, we are boss. So they are living in the wrong belief that they are the boss. So right now, which standards, how many standards are in effect? IAS 1 to IAS 41, but under that only 25 are effective. Many IAS have been deleted. Okay, and IFRS 1 to 17 are effective. Both together are known as International Financial Reporting Standard. Okay, IFRS composition now. So what you have to study in IFRS? You have to study International Accounting Standard number from 1 to 41, IFRS which were issued by IASB after April 2001, SIC which were the interpretation issued by IASC for IAS, and IFRIC. What is IFRIC now? IFRIC is the interpretation of IFRS. SIC is the interpretation of IAS. Okay. So now whenever they issue interpretation on an IFRS, it is issued by this committee called IFRIC. Full form is Interpretation by International Financial Reporting Interpretation Committee on IFRS. This is IFRIC, IFRIC. So they give interpretations on standards. Now we'll come to India. Is IFRS there in our syllabus? The answer is no. We don't have to study IFRS. But really speaking, Ind AS and IFRS are not very different from each other, because Ind AS is the converged version of IFRS. There are only 7 major differences which are called carve out or carve in, and remaining standards are same. Only some nomenclature may be different here and there, but they are not major difference. The major accounting differences are only few. So if you have studied Ind AS, you have studied IFRS also. If you study the differences, then you can also understand IFRS also. By studying Ind AS, you can appear for the diploma IFRS exam also with the differences that you know, plus their format of exam is slightly different. But you don't have to do any extra coaching. Trust me, we will cover lot of questions, including some diploma IFRS question, that you will not be required to undergo separate coaching for diploma IFRS immediately after your final exam. After, not before. You should also appear for diploma IFRS exam. Trust me, because that will add value to your CV. Is it right? Because companies are going global, so they require people who have knowledge of Ind AS plus IFRS. And over a period of time, the gap difference between IFRS and US GAAP will also not be much, because slowly and slowly this US GAAP body is also trying to follow the principles of IFRS. They sit together to formulate the standard now. So let us start with Indian scenario. 1981, the Institute of Chartered Accountants of India, they formed one body called ASB, Accounting Standard Board. It was motivated by IASC, because if you see in 1970 this IASC was formed. So in India also we started issuing recommendatory standard by forming ASB. So when they were issuing standard in the beginning, it was recommendatory in nature. How many standard ASB have issued? Do you know that? Intermediate, what was the last standard? Group 2, AS29. But you may not be knowing, they had also issued AS 30, 31 and 32, which later on they have withdrawn. So these three standards were on financial instrument, very complicated. India was not yet ready for adopting such complicated standards, so they have withdrawn it. So 29 standards are there, but out of that also AS6 is not there now, that is eliminated. AS8 has been eliminated. So AS6, AS8 have been eliminated. Initially AS was recommendatory, accounting standard was recommendatory initially. Okay, who are going to follow accounting standard? Accounting standards will be followed for general purpose financial statement of companies. Sir, what do you mean by general purpose? General purpose means it is not prepared specifically for a particular group. For example, if you go to take a bank loan, the bank will want the data in their format and you don't have a choice. You have to put the data in the format of the bank. Then that is not a general purpose financial statement. Or suppose you have to file tax return. So I think they ask you to give data in a certain format. But that is only for tax return filing. That is not general purpose. General purpose is not specifically meant for any particular group. So same financial statement can be used by shareholder, the investor, creditor, debtor, employee, management, and anybody wants. But remember, AS is also applicable for non-corporates. Some student will ask whether it is applicable for partnership, proprietorship. The answer is yes. It is also applicable for NGOs, non-governmental organization, or not-for-profit companies. That section 8 companies will also follow accounting standard. Accounting standards are not applicable for tax computation. For tax computation, we follow the rules of income tax. Similarly, accounting standards are not applicable for budgets. Management will prepare budget as per their requirement. Accounting standard accounting standard to inventory says follow absorption costing for inventory valuation. But some management may simply say, no, we'll follow marginal costing for decision making, because whatever fixed cost I am incurring. But for decision making, I require marginal costing. So internally, they may prepare budget based on, say for example, marginal costing. And it is okay internally, because that is how it is. Now I will come to one very important year 2006. What happened in year 2006? Before that, accounting standards were not mandatory. Although companies were following accounting standard, but it was not mandatory. So there were deviations. But in 2006, we had issued Indian Accounting Standard Rule 2006, which made accounting standard mandatory. Plus, what happened on the IFRS front? Indian government expressed its commitment to converge with IFRS. So there was a G20 meeting Okay, G20 meeting takes place nowadays quite often in India. And when G20 meeting happens, that city is beautified. And once the meeting is over, things are back to original situation. So in G20 summit, our Prime Minister MMS Manmohan Singh, okay, he committed that India will also either adopt or converge to IFRS. Because this was a complaint by the international investor that your financials are not trustworthy, reliable, comparable. So we don't want to invest in your country. So he said, don't worry, we are also going to converge to IFRS. Why India wanted to converge to IFRS? Because Indian economic environment is different than European and other developed countries' economic environment. So we are going to converge with IFRS. We are not going to adopt IFRS. What is the difference? In case if you adopt IFRS, it means you will simply take the entire IFRS as it is without any changes. But if you converge with IFRS, you are going to make some modification to suit the Indian business and economic environment, legal environment also. For example, in Companies Act, they use the term balance sheet, but IFRS uses the term statement of financial position. So if the companies write statement of financial position and the Companies Act says company will prepare balance sheet, there is a difference. So we thought that instead of using the term statement of financial position, we will continue to use the term balance sheet. That was one example. Some small countries, even bigger countries also, who do not have enough resources to redesign IFRS, or for whatever reasons, they have decided to adopt. Many of them have adopted. Okay, like our neighbor, friendly neighbor, Pakistan, Canada, Bahrain, Cambodia, Sri Lanka, they have adopted IFRS. But India has decided not to adopt the IFRS. India has decided to introduce the modified version of IFRS. Modified version. Okay, so that is why it is called converged version of IFRS. One important event happened in this year. Company Accounting Standard Rules 2006 were introduced, notified, and because of that, accounting standard became mandatory. Now the auditor will have to check whether all the applicable accounting standards were followed or not. If not, he will write a what they call qualification. Is it right? One of the most important events happened in 2015, and in this year what happened? In this year they issued company Indian Accounting Standard Rule. Indian word is extra here. That means now they have given a roadmap. They have given a roadmap now that how Ind AS will become applicable in India. So MCA, under the recommendation of NACAS, National Advisory Committee on Accounting Standard, notified Ind AS, and the notification date was February 16, 2015. So now after that, companies have to follow Ind AS, who will fulfill the applicability criteria. To avoid confusion, remember, only those companies which will fulfill the applicability criteria will follow Ind AS. Some companies are allowed to voluntarily follow Ind AS, and some companies are not even allowed to follow voluntary Ind AS. For example, banks cannot follow voluntary Ind AS. Insurance companies cannot follow voluntary Ind AS, and certain NBFCs cannot voluntarily follow Ind AS. Okay, so we'll come to applicability part in a while. I hope you are enjoying. Any query, students who have joined online? Anoop, any query? Hari, any query? Okay, no problem. So we'll come to 2015. Ind AS were modified form of IFRS. So if they ask you in the question, in the interview, what is the difference between converged version of IFRS and adopted version of IFRS. Adopted means as it is. Converge means with some modification. Why modification? To suit the Indian legal, business, economic, political, social environment, but mostly legal and business environment. Okay. We have taken convergence approach. We have made some changes. The major changes are known as carve out or carve in. Minor changes are not carve out, carve in. Major changes are carve out and carve in. Is it right? We will discuss what are carve out, carve in different chapters where we will come to that. I will tell you this is carve out and you will have to mark it. Sometimes certain things are not in the IFRS, but we have introduced that. We have introduced one important thing is in Ind AS 103. We have added one concept called common control transaction, which is not in IFRS, but India has made that addition in our standard, which what you call in intermediate pooling of interest method of amalgamation. In IFRS there is nothing like pooling of interest method, but we have brought that in our accounting. So that I will discuss in Ind AS 103, that is carve in. Something new was added. And there are few omissions also, something we have not considered in our standard, they are called carve out. Okay. If there is carve in or carve out, then you have to give more disclosures. More disclosures will be required for carve out, carve in items. So what we'll do, these differences or the modification that we have made, we will divide into three categories. We will divide into three categories of changes. That is the difference between Ind AS and IFRS will be broadly divided into three categories. First category, which is not carve out, carve in. It is just the changes in terminology used. Example, we will call balance sheet. In IFRS they call it statement of financial position. We will call statement of profit and loss. In IFRS it is called statement of comprehensive income. The reason is that we want to use the same terminology which is used in law, Companies Act. So Companies Act was passed in 2013. So that time they used the term like balance sheet, statement of profit and loss. So either I have to amend company law or I have to amend IFRS, which is easier. Modifying IFRS is easier because changing the law means parliament approval etc. would be required. Parliament people are busy in right now buying and selling the MLA and MPs only. They don't have time for other things. Next point number 2. Is removal of options in accounting principles and policies. Now in IFRS you have some places you have more than one options to choose from. Like for example, interesting example, there you can prepare a financial statement which will be based on either 1 year or 52 weeks. And now all of you know 52 weeks is not equal to one full 365 days here. In India we don't have that. We have to follow financial year starting from 1st April to 31st March of the next year. So here I am not giving you a choice. Another example is statement of comprehensive income. In India we have to prepare statement of comprehensive income in one format only. Okay, India. In IFRS you have two choices. Either you can prepare only one format which will contain the profit and loss and OCI part. OCI means other comprehensive income. Or you can prepare two statements. One will cover P&L account item and one will cover OCI item. So we have thought that we will not give two options. We will only continue with one single format. Is it carve out? or carve-in? The answer is no, because these are just cosmetic changes. This does not make any real change. Same figure will appear whether you write in one page or you write in 2 pages. But the third type of differences are called carve out and carve in. These are called major differences. First was change in terminology. Second was certain options were removed. And the third one, which are major ones, they are called carve out, carve in, where there is a major deviation between Ind AS and IFRS. Okay, major deviation, because we will see later under IFRS, if you default on balance sheet, even if you get it rectified by the balance sheet date, they say it is a current liability, because your default was there on the balance sheet date. What our brainy people did in Ind AS, they said if you have defaulted on balance sheet but you got it rectified before the balance sheet is approved by the director, it will go back to non-current liability. How does it make a difference? If it is a current liability, it will affect your current ratio, quick ratio, liquidity ratio. So lot of ratios get disturbed. Is it right? And getting further loan will become difficult. But India is a land of defaulters. We are going to protect our defaulters even on the balance sheet. Is it right? Don't write that. So this is just a device to protect even companies which have defaulted, but somehow by hook or crook they got it rectified by the balance sheet date, approved. And that managing people in India is very common job. Okay. And if you are connected to political party, it is even easier. So why carve out, carve in was made? Theory question for you, or even interview question, that why we had to make some changes. One is, as I am repeating again and again, Indian economic, business, political, social, legal environment is not same as European countries or other developed countries. Is it right? As I gave you the example of loan. In India, defaulting on loan is more frequent than other countries. India still has to raise funds. Okay, we don't have enough funds. So we have to ensure that our balance sheet does not contain certain item which might affect your ability to take the loan or funds from investor. So that is why political it is different in the industrial and economic environment. These are aimed at creating an acceptability to the converged accounting standard. One more thing, if you just make the companies follow IFRS as it is, they will be very reluctant, because they complain that our financials are getting disturbed because of your standard. Banks are not following the Ind AS right now, because every time RBI wants to make the banks follow Ind AS, then a lobby starts and they postpone it. The reason is that under RBI regulation, NPA is declared after 90 days. Under Ind AS 109, a financial asset becomes credit impaired after 30 days. So imagine lot of loans and advances of banks which are right now not an NPA will become an NPA, and the provision requirement is also very harsh in Ind AS. It is much more than what RBI prescribes. Banks will probably start showing losses. NBFCs will start showing losses. And that is why every time RBI wants to introduce Ind AS, bank says we are not yet ready, our system is not ready, our people are not yet ready. Okay. And that is why they have to make these carve-in, carve-outs. But sooner and or later, these carve-in, carve-outs will get eliminated. Because if India has to really become a global power, then the standards also have to be of the global standard. Otherwise, you will not get funding. Many of my friends working in foreign banks, foreign equity research company, they say we don't understand your standard. Why it is different in this particular region? Okay. Second reason which they have given is a simple reason, that it will result into better presentation as per Indian environment. Third is, we wanted to remove options. Indians are already too creative without option. Yes or no? And what happens if you give them option? They will become more creative, making comparisons will become difficult. And this is a genuine reason for carve-in carve-out. You will find some carve-in carve-out in the Ind AS 101, which is called first time adoption of Ind AS. When you are migrating from accounting standard to Ind AS, you will have to make lot of changes. Ind AS requires that you should make these changes from retrospective effect. Now see the problem. If you have purchased a property, plant, equipment 15 years ago, you will have to recalculate its carrying amount today as per Ind AS. And this is one example. There can be so many examples. Government loan can be there. Under old standard, we had a different method. Government grants are there. ESOP accounting is there. So they are giving you some relaxation, exemption and changes. And that is why carve-in carve-outs are made. Otherwise, transition will become very difficult, especially for small companies who do not have necessary resources to do the transition. And if you hire experts, their fees is very high and they cannot afford it. So therefore, they decided that first time we will give you lot of relaxation. Okay. Next paragraph is convergence with IFRS. I repeat, this paragraph again says we have decided to follow convergence route, not the adoption route. Okay. That means we are going to make certain changes as per Indian economic and legal environment. Like one example I have given, balance sheet instead of statement of financial position. And one more minor change is there in Ind AS 1. Instead of using the term true and fair, we can use the term presented fairly. Okay. Or in IAS 1 it is presented fairly, but you as a student are used to this term true and fair. So we have made some cosmetic changes, but these changes will not make it adoption. Okay, changes will not make it carve out also, carve in also. So Ind AS is, you can say, modified version of IFRS, right? Some country like Hong Kong and China, they have also converged with IFRS. We are not the only one. Okay. So those countries which think that no, we need to make some changes in the IFRS, they have decided to converge. Why IFRS has been converged, or why did we decided to follow Ind AS? Is it right? Why don't we simply continue to follow accounting standard? Global requirement, standardization. Suppose this is a room. In this room there are 4 persons. One is Indian, who can speak only Hindi. In this room there is a Chinese, who can speak only Mandarin, Chinese language. Then there is a German person who can speak only German, and there is a US person who can speak only English. How will they communicate? How will they communicate? They can't communicate. They will not trust each other. Okay. They can misinterpret each other if they talk in sign language. But if all of them follow a common language, let us say English, then each of them can understand each other. Same goes with the standards. If every country follows their own set of standard, then nobody will trust each other. Nobody will rely, no financial statement will be reliable. Funds will not flow smoothly. Or every time you have to convert your standard into the standard of the other party who can understand it, and imagine how much time, energy, cost that will involve. If you are working in the finance department or accounts department of a company which has got multiple subsidiaries in different countries, you understand the problem. Different subsidiary prepare financial statement in different currencies, different standard, and then you bring them under your standard. It takes a lot of time. And imagine if you are a listed company, quarterly reporting is required, so the same exercise you have to do 4 times. Is it right? So that is why we require a standardization. You can simply take financial statement of an Indian holding company, Chinese subsidiary, only you have to convert the foreign currency into functional currency, for which we have a standard and which is very simple also, and then you can easily consolidate. But if you have to change entire balance sheet, P&L account item, then it is really going to be complicated. So that is why a single set of standard will enable internationally to standardize training and assure better quality on a global screen. So second reason is comparability. We can compare financial statements of 2 companies which are in 2 different countries now. That is one of the big advantage for the investor. Third is why India decided to converge to IFRS is we want funds. It is not enough. Indian investors do not have deep pockets which foreign investors have, but foreign investors have conditions. We will give you money, but I want financial statement as per IFRS. So that is why we have to convert, so that we can attract global capital, and in a sense it will become beneficial to regulators also. Okay, while making policies, while doing taxation calculation. So if you have a subsidiary abroad, if they also follow the same standard, you also follow the same standard, it will be easier for the regulators to do the planning, analysis, formulation of policies, tax policies and other things. Otherwise they are also confused. And one of the major reasons why we decided to converge is consolidation. When this Ind AS was not there, see the problem that used to happen. We were an Indian parent company, and this has got subsidiaries in USA, say Japan or UK, Germany. They are following German GAAP, it is following UK GAAP, it is following their own Japanese GAAP or something, US GAAP. Each of these subsidiaries will prepare the financial statement in their GAAP. They also have to prepare financial statement as per Indian GAAP, so that the Indian parent can consolidate them. Imagine the difficulty. It's a listed company, so same exercise they have to do 4 times in a year. They will require experts to do this convergence. Is it right? And some of the investors, they insist that this convergence should be done by big 4 companies, KPMG, PwC, E&Y and like that, Deloitte. But these big 4 companies come with a big price tag also. Their fees is also very high. Probably you will not be able to afford it. What if all of them follow same standard? The consolidation will become easier, faster, less effort will be required. I have seen this finance people sitting till 12 o'clock at night, 11 o'clock at night and just doing this consolidation thing only. Okay. So that was lot of efforts required. Now we'll come to process of development and finalization of Indian standard, Indian AS. So just quickly we'll go through it. Such questions are not asked in the exam, but because it's a part of the syllabus. So in India, the process starts after the IASB, International Accounting Standard Board, issues an IFRS or updates an existing one. We don't issue new IFRS on our own. Only if something is new in IFRS or some amendments in IFRS, some updates in IFRS, then only our institute will become active. They can't do anything on their own. Of course, some carve in, carve out they can make, and in some cases. So this is IASB, it has issued an IFRS. Then deliberation and consideration of draft Ind AS in line with IFRS by ASB. So ASB becomes active now. So ASB will always look at IFRS. Is something happening? Is it right? Like a detective looking at the window. Something is happening. Oh, let us inform the institute. Okay? And then the institute will sit down and it will issue a draft Ind AS. Draft means their first version, not final version, which is based on IFRS, and then it is circulated to the council member of the ICI and also specified outside bodies like SEBI, then CA and AG, Controller and Auditor General, CBDT, Central Board of Direct Tax, even RBI, Company Secretary Institute. So some outside agencies or organizations, they are also shared this draft, and then issue of exposure draft for public comment. If you look at the institute website, they will come out with exposure draft. Before that, sorry, we will go to this one. Meeting with the representative of the specified outside bodies to ascertain their views. So they will call the meeting of people from SEBI, C&AG, CBDT, RBI, Company Secretary Institute, and that ICMA Institute, and they will offer their suggestion. After receiving their suggestion, they will incorporate in the draft and issue exposure draft for public comment now. So you will find on the ICI website, even you can comment. You can say that no, I want that it should be like this. So then they start collecting comments from a large number of people and they will prepare a final draft. The final draft is submitted to NFRA. What is that NFRA? I forgot. National Financial Reporting Authority with recommendation, and then NFRA, if it is satisfied, it will notify Ind AS under Companies Act. So a notification will come in the official gazette with all the text of that standard, and then it will become applicable. They will also mention from which date it is applicable. Is it right? So one day you can also join Accounting Standard Board and you can also issue standards. It is not impossible. You can do it. Now next is on which we will solve about 7 or 8 questions. So listen to me carefully. These questions are from the material. So anything from the study material is very important from the exam point of view. Applicability of Ind AS. So Ministry of Corporate Affairs have notified companies Indian Accounting Standard Rule that I have told you. So right now how many Ind AS have been notified which are applicable? 39. I will tell you the list later on which are those 39 standard, and then it has also given a road map. Road map means how the Ind AS will be applied by different entities. So we have 2 types of entities. One is NBFC. For them the road map is different, and other than NBFC for which the road map is different. Right now Ind AS are not applicable to banking and insurance company. they have been postponed till further notification. With respect to bank, RBI will issue the notification, and with respect to insurance company, IRDA will issue notification. In fact, there is a IFRS 4 which is called insurance contract, but not applicable to us anymore right now, and there is an IFRS 17 which is again insurance contract. The same standard have been amended, but right now in India it is not applicable. So IFRS 4 is not applicable, which is the old version. IFRS 17 is not applicable, which is the new version. In India, the standards were made mandatory on a phase-wise approach. What is phase-wise? First, they will make applicable to listed and very big companies, then to the next level of companies. If you make it applicable to everybody at a time, it is little difficult to apply. Companies should also be ready, right? Now, in your syllabus, they have mentioned about phase 1, but that phase 1 has become very old now. Phase 1 started from 1st April 2016. Is it right? Following companies were covered under phase 1 for accounting period beginning on or after 1st April 2016. That means in India, Ind AS actually started from financial year starting on 1/4/16, but that is not enough. The year ending date for this will be 31st March 17, but for comparison purpose, you have to also give a financial statement of 15/16, plus in the first year when you apply Ind AS, you have to give one opening balance sheet also. So really speaking, you have to start working from much earlier date so that you can prepare one opening balance sheet on 1/4/15, comparative balance sheet on 31st March 16, and the balance sheet of that financial year on 31st March 17. Is it right? Which companies were covered in phase 1? First is, in simple terms, listed company or company in the process of listing. How to remember? Listed or in the process of listing, whether in India or outside India, and word underline, and having net worth of 500 crore or more rupees. So listed or in the process of listing, plus it should have net worth exceeding 500 or more than 500 crore. We have to check net worth will be calculated on which date. For that there is another discussion. Net worth should be calculated on which date? I will tell you that. That is pending from my side. And second question is, what is included in the net worth? What is included in the net worth? And net worth should be calculated on which date? Because net worth will change every day. If today I earn 10 rupees profit, my net worth will today be higher by 10 rupees compared to yesterday. Then this is my first. So listed or in the process of listing plus net worth equal to or more than 500 crore. Second is companies other than those covered by clause A above and having net worth of rupees 500 crore or more. So this means it is not a listed company. Other than listed company, you can say unlisted company whose net worth is 500 crore or more. Because if it is listed and more than 500 crore, it will get covered under first clause. Not only that, your holding company, your subsidiary, joint venture or associate companies will be also covered from that date. So if suppose this is X, it is listed plus net worth more than equal to 500 crore, it is applicable. It has a parent company Y, irrespective of the status of parent company. Parent company may be unlisted, net worth 2 rupees only, 100 rupees only, still applicable. It has a subsidiary A, applicable. It has an associate B, applicable. Joint venture, applicable. Subsidiary, associate, joint venture, they will also start following Ind AS. So Ind AS is like coronavirus in a family. Ind AS is like coronavirus in a family. If one person is affected, all family members get affected. Is it right? So that was phase 1. So phase 1 I will revise. Listed company or in the process of listing plus net worth equal to or more than 500 crore, or unlisted company with net worth more than 500 crore, and if you are a subsidiary, parent, associate or joint venture of either of the above two companies, then you have to follow Ind AS. Why these companies have to follow Ind AS? Because in order to consolidate, all the financial statement which we are consolidating should be based on same standard. On that we have lot of questions also for the later part. If you are consolidating A and B, their financial statement should be based on same standard. Is it right? Now let us come to phase 2. Phase 2 means the company which are covered, following companies were covered under phase 2 for accounting purpose for period beginning on or after 1/4/2017, and they will have to give a comparative of 31st March 17. So their financial statement will be 1/4/17 to 31st March 18. Comparative will be 1/4/16 to 31st March 17, and opening balance sheet will be given, will be 1/4/16. So companies actually started working on Ind AS 2 years in advance only. Is it right? Those which they knew that we are close to following Ind AS, they started working on this 2 years in advance. Because to prepare a balance sheet on 1/4/16 also you need the data of 15/16. Is it right? So which companies were covered? Companies whose equity or debt securities are listed or in the process of listed on Indian Stock Exchange or outside India, and having net worth of less than rupees 500 crore. Understood? What is the difference here? In phase 1, listed plus net worth should be greater than or equal to 500 crore, but in phase 2, listed but net worth is less than, that means only listed company, all listed company will get covered now. So in short, now current situation is all listed companies are covered, because even if their net worth is 0, still they are covered. It is less than 500 crore. So they could have, I think they should have simply drafted it as all listed company or in the process of listing. Anyway, now next is companies other than those covered in A above, that is unlisted company having net worth of rupees 250 crore or more but less than rupees 500 crore. Is it right? So they could have just written more than 250 crore. Okay. So now in current situation you have to just remember like this: listed company and net worth more than 250 crore. Any company whose net worth is more than 250 crore, although there are few exceptions like NBFC, bank, insurance, we will see. Okay. And as I said earlier, they are holding subsidiary, associate and joint venture, they will also have to apply Ind AS. So summary of applicability I have written in the small box. This is for, write in bracket, not a finance company, not an NBFC, right? This applicability that we have seen is applicable if the entity is not, an NBFC, because for NBFC the roadmap is different. So this summary I am going to read now is applicable to companies other than NBFC, banking and insurance. Understood? So in short, I will remember as on date, Really speaking, only this much should be given in the notes, that as on date listed companies in the process of listing any security, whether it is a debt or equity, on any exchange, whether India or outside India, and companies whose net worth is, unlisted companies whose net worth is or equal to, net worth is, you can just put a sign of equal to also, greater than or equal to 250 crore on the 31st March of the previous year. Can you see that? 31st March of the previous year. So now what I'll do, every year I have to check on 31st March what is the net worth of the company. So this is your current practice now. Now you don't have to remember 2016, 17, etc. because we have crossed so many years. So every year end you have to see what is the net worth, and if it exceeds 250 crore, immediately from the next year Ind AS will become applicable. So suppose this is 31st March 23, your net worth is greater than 250 crore, then from 1/4/23 you have to apply Ind AS. Is it right? So company will have to apply Ind AS immediately from the next year.
What if it falls below 250 crore?
What if it falls below 250 crore next year? I will tell you later. That is also a part of the syllabus. Once Ind AS is applied, then it is applied forever. Then even if the net worth falls below 250 crore, or even if it becomes an unlisted company from listed to unlisted, then also it will continue to apply Ind AS. Once you become CA, you are CA forever. You don't have to check what you do afterwards, okay? So you can become a film artist, you are still a CA. You don't have to appear for the exam. Once a CA, always a CA. Once Ind AS, always Ind AS. Now we'll come to NBFC. NBFCs were given relaxation in the initial year, because the reason is, in India the problem of bad debt is very high in case of NBFCs also, because people take loan, they don't repay, then they have to present it in the balance sheet as outstanding. If I apply Ind AS, many of these NBFCs would have reported losses, lower profit. And what happens when you report lower profit? Share prices will fall down, collapse. Okay, so therefore they were given some time to improve their financials, and that is why to NBFCs the applicability was postponed for some years. So they are going to apply Ind AS in two phases. Phase 1 is for accounting period covered starting on or after 1st April 18, and they will have to give a comparative of 31st March 18. So 1/4/18 to 31st March 19 will be their first financial statement under Ind AS, and you will give a comparative which will cover the period 1/4/17 to 31st March 18 with an opening balance sheet on 1/4/17. Same thing applies here also. Now which NBFCs will apply Ind AS from 1/4/18? Those NBFC whose net worth is 500 crore or more, whether listed or unlisted, and holding subsidiary, associate, joint venture. They are holding subsidiary, associate and joint venture of NBFCs already covered under clause A above, other than companies already covered under Ind AS roadmap for non-financial companies. But if any company, any subsidiary is already covered under Ind AS, which is a non-finance company, then they have already been covered. So no problem with that. But what about phase 2? Phase 2 means accounting year starting on or after 1st April 2019. So this company will have to present financial statement covering the period 1st April 19 to 31st March 20. Comparative will be 1/4/18 to 31st March 19, and one opening balance sheet will be given as on 1/4/18, and which are covered here, listed or in the process of listing, listed or in the process of listing, plus net worth less than 500 crore rupees. Because if net worth is more than 500 crore, they are already covered under phase 1, and then they are saying NBFCs that are unlisted having net worth of 250 crore or more but less than 500 crore. To put both these phases together, now it is simple. If it is a listed NBFC, Ind AS is applicable, or if its net worth is 250 crore or above, Ind AS is applicable. So for which NBFC Ind AS is not applicable right now? Unlisted and net worth below 250 crore. But if it is applicable to NBFC, it is also applicable to its holding subsidiary, associate, joint venture company which are covered under A and B, other than companies already covered under Ind AS roadmap for non-financial companies. So if those non-financial companies are already covered, then they will have to follow Ind AS in any case. So I have made a small summary for NBFC also. Summary, write down. Summary of applicability for NBFC. As on date, today, if somebody asks you whether this NBFC will follow Ind AS or not, you just have to look at these 3 points. Whether it is a listed or in the process of listing in India or outside India, any stock exchange, yes, applicable. Whether its net worth is equal to or more than, write a sign of equal to here, equal to or more than 250 crore on 31st March of the previous year, yes, Ind AS is applicable. And whether it is a holding subsidiary, joint venture or associate of companies covered above, then Ind AS is applicable to them. So this is my current position. Unnecessary asking phase wise question is useless after so many years, but they have asked, so we have to reply. Okay. So application of Ind AS to NBFC. Now understand that there can be a situation where parent is NBFC and subsidiary, associate, joint venture can be not NBFC, or there can be a situation where parent can be non-NBFC but subsidiary, associate, joint venture can be NBFC. So how do you deal with that? Because if it is an NBFC, then the Ind AS will be applicable only from 1/4/18 or 1/4/19. But then if the parent is a non-NBFC and subsidiary is an NBFC, what the NBFC will do? Whether it will apply Ind AS or not. Is it right? So this question will be answered now. Application of Ind AS to non-finance company whose parent or whose subsidiary or associate or joint venture is a NBFC. So see one by one, and the problem will be there because the applicability date is different for NBFC and for non-NBFC. But I think now that problem should not be there, because that problem would have come in the earlier years around 1920, 1819, but in 23, 24, 24, 25 such problem will not arise because now they have to follow Ind AS. Anyway, let us see. The date for application of Ind AS to NBFC is not aligned with that of that date of application of Ind AS to non-finance companies is not aligned with that of NBFC. We have already seen. Hence, it has been clarified in the notification that the company shall apply accounting standard or Ind AS on the basis of the respective standard applicable to them. On the basis of respective standard applicable to them. So I am going to take two situations. Case A, you can underline this portion, case A, which I have written in red font on the screen, where an NBFC is a parent. NBFC is a parent at ultimate level or intermediate level and prepares CFS as per accounting standard. CFS is prepared as per accounting standard. As per accounting standard means not as per Ind AS. And its subsidiary, associate, joint venture. So I will write SAJ, either subsidiary or associate or joint venture, are non-finance company. These are non-NBFC. Are required to prepare financial statement as per Ind AS. Oh my God. Parent company is an NBFC. Parent company NBFC is not following Ind AS. Subsidiary or associate or joint venture which are non-NBFC, they are following Ind AS. So now the question is, in the earlier part of the discussion we have seen, if Ind AS becomes applicable to one company, its parent will also follow Ind AS. But this time the parent is NBFC, not yet covered by the roadmap. Not yet covered by the roadmap. Then what will you do? Then such subsidiary, associate and joint venture shall prepare its financial statement as per Ind AS. So their financial statement will be as per Ind AS only, because Ind AS is applicable to them. Now the question is, you will answer, for consolidation purpose here, whether Ind AS will be consolidated here or they will have to prepare one more set of financial statement which is based on AS, or whether NBFC should follow Ind AS. NBFC can't follow Ind AS, okay, unless it falls under roadmap. So this clarification is that such subsidiary, associate, joint venture has to provide the relevant financial data in accordance with accounting policy followed by the parent company for consolidation purpose. Oh my God. So this subsidiary will prepare two sets of financial statement. One as per Ind AS, because Ind AS is applicable to it, and one as per accounting standard or the accounting policy followed by NBFC parent company, so that NBFC parent company can consolidate. Is it right? So Anup, who is attending online, he also said one more set will have to be prepared. So if the institute gives you this case study, then this is the answer you will have to write, that it will have to prepare two sets of financial statement. Okay, now reverse question. When a parent company is a non-finance company, parent is a non-NBFC, it is covered under Ind AS and it has an NBFC, a subsidiary, associate or joint venture NBFC. The parent has to prepare Ind AS compliant. So of course parent will prepare Ind AS compliant because it has come under applicability. But what about the NBFC? An NBFC subsidiary, associate or joint venture has to provide the relevant financial data in accordance with the accounting policy followed by the company for consolidation purpose. So this NBFC will have to prepare two sets of financial statement now. One as per accounting standard for their own purpose, because they are not yet covered by the roadmap. If they are also covered by roadmap, then there is no problem. If both are covered by Ind AS, then where is the problem? The problem is that NBFC is not covered. So NBFC will prepare one financial statement as per accounting standard and one more financial statement as per Ind AS, only for the purpose of consolidation. Okay. only for the purpose of consolidation, because parent company cannot follow AS once Ind AS is applicable. Parent company cannot follow accounting standard if Ind AS is applicable. So the subsidiary has to give financial statement under Ind AS for the purpose of consolidation. Is it right? It implies that NBFC subsidiary, associate or joint venture in such case shall continue to prepare financial statement under AS. So their life will be little miserable here, because they have to prepare accounting standard based financial statement also and Ind AS also. One student is asking whether class notes is available for sale, can be used in the exam. Yes, you can use class notes for exam purpose. And good evening to everybody who has joined now or little before. Okay, thank you for joining. So let us solve question 1. Good news, answer is printed. You don't have to write the answer. We will discuss the answer and you will read the answer on your own. Ready? Source of the question is study material of the institute, and I expect such question can be asked for 4 marks, although the chances are less, but it is not 0. Okay. As per the roadmap, Ind AS is applicable to company X from the financial year 17-18. X will follow Ind AS from 17-18. Company X, non-finance company, so it is a non-finance company. I will write non-NBFC, is a subsidiary of company Y, which is NBFC. So Y is an NBFC and Y is the parent, and this X is a subsidiary non-NBFC. Company Y is an unlisted NBFC. Y is unlisted NBFC having a net worth of 400 crore. Having a net worth of 400 crore. What will be the date of applicability of Ind AS for company X and company Y? What will be the date of applicability of Ind AS for company X and company Y? So company X is already given in the question, so it will apply from 1/4/17. And what about Y? Net worth is 500 crore, but it is an unlisted company. So can it apply Ind AS from 1/4/18? 1/4/18. For 1/4/18, its net worth should be 500 crore or more, but it is only 400 crore. Okay. And from phase 2 applicable, either it is a listed company or unlisted company whose net worth is 250 crore or more. So this will be applicable from 1/4/19. Okay. What will be the date of applicability? If Ind AS applicability date for the parent NBFC is different from the applicability date of corporate subsidiary, so parent will apply from 1/4/19. Then how will the consolidated financial statement of parent NBFC will be prepared? So before 1/4/19 it will prepare as per accounting standard, and the subsidiary will prepare 2 sets of financial statement. One as per accounting standard for consolidation with NBFC, and one as per Ind AS because Ind AS is applicable to it. Is it right? So can you just read the answer on your own? Just read the answer on your own. I will have some H2O. H2O means water. Is the answer right? Same answer is printed here. So if your concepts are clear, you will be able to solve. And such chapters will require revision because dates are important. Many students may not be able to remember the date. Now, a very important paragraph appearing is how to calculate net worth. Because by adding something, you can increase or decrease the net worth. So they have made it very clear what will be included and what will be excluded in the net worth, and we can expect a question, numerical question here, which I am going to take also. So net worth, I have simplified the wordings of the standard for you. You will take equity share capital. You will take preference share capital if it is treated as equity. If it is treated as equity. Under the Ind AS 32, preference share can be equity or liability. But under the old accounting standard, it was treated like share capital only. This concept of equity and liability for preference share has come only under Ind AS. But because I was not preparing Ind AS financial statement, which financial statement we are talking about here? Prepared under accounting standard. Because we are checking applicability of Ind AS, so it means the company is not following Ind AS. So preference share, securities premium will take, free reserve we will take, which are available for dividend. What about capital reserve? Capital reserve arising from grant received on promoter contribution. In our accounting standard of intermediate syllabus, there was AS 12, which is called accounting for government grant. Under that standard, you have studied grant in the nature of promoter's contribution or grant which are in the nature of capital subsidy. They are directly credited to capital reserve. If the capital reserve is grant in the nature of promoter contribution, you have shown under accounting standard 12, that will be considered, but other capital reserve will not be considered. Other capital reserve will not be considered. Then minus accumulated losses and deferred expenditure. That means if you have a loss in the balance sheet, P&L account debit balance, any deferred expenditure, any miscellaneous expenditure not written off like discount on issue of debenture, preliminary expense, underwriting commission, if it is appearing, then you have to reduce it as per the audited balance sheet. Then I have mentioned some important notes because you will get a question on this. Do not include any other capital reserve or any specific reserve. Any specific reserve like development rebate reserve, investment allowance reserve will not be considered. This is clarified by the institute in FAQ, frequently asked question. So if you do the search on Google, you will find one FAQs on applicability. Then do not include reserve created out of revaluation of assets. So revaluation reserve will not be considered. Do not include reserve created out of write back of depreciation or amalgamation. So this is mentioned in the applicability rules itself, that revaluation reserve created out of write back of depreciation or amalgamation will not be considered. Now the question student had asked me in the earlier batch was, why grant in the nature of capital contribution shown as capital reserve is treated as net worth? Because under IFRS, even the grant in the nature of promoter contribution is called free reserve, and therefore we decided that we will include that in the free reserve. Then what about share forfeiture account? In foundation course there was some share forfeiture account. Share issued, party did not pay the call money, we forfeited. So share forfeiture account is not included if appearing on the balance sheet. Next question is whether net worth will be calculated on standalone balance sheet or consolidated balance sheet. Yes, it has to be standalone balance sheet, because first we have to check the applicability to a single company. Okay. Next question is, one student had asked also, what if the net worth falls below the prescribed limit or if the company becomes a listed company? Once you have followed Ind AS, okay, then an entity will be required to follow Ind AS for all subsequent financial year, even if the net worth gets below 250 crore or it gets unlisted. And next is, when will you calculate the net worth? So right now we will calculate net worth on the last day of the previous year as per the audited financial statement. So every company other than banking and insurance company will have to check their net worth on 31st March every year. And the moment if you find it exceeds 250 crore or more, then immediately from the next year Ind AS will become applicable. Examples: company which meet net worth criteria for the first time on 31st March 2023 will apply the Ind AS from financial year 2023-24. Then some more question from the institute and FAQs. Whether private limited companies are required to follow Ind AS? Yes. If they follow, if their net worth is 250 crore or more. Whether Section 8 companies are required? Section 8 means those companies which are not for profit. The answer is again yes, if their net worth is 250 crore or more, or if they are listed. Then can a company voluntarily adopt Ind AS? The answer is yes. But insurance company, banking company, NBFCs which are not covered under roadmap, they are not allowed to voluntarily adopt Ind AS. And remember, once you adopt even voluntarily Ind AS, then later on you cannot revoke. Is it right? You can't follow Ind AS in 1 year, accounting standard in another year. That is not allowed. So think carefully before you voluntarily adopt Ind AS. Think carefully. Okay. Is Ind AS applicable to government company also? The answer is yes, if they meet the applicability criteria. So private, government companies, Section 8 companies does not matter.
NBFCs also cannot voluntarily.
NBFC also cannot voluntarily follow Ind AS. NBFC, insurance and banking companies will not voluntarily follow Ind AS. I have mentioned in the notes somewhere. Every query that you have in mind is there, but we'll go line by line. Now, one paragraph I am reading now, which I believe is a wastage of time. Then, sir, why are you wasting time? We are the slave of the syllabus. Okay. So, we have to follow that. When will net worth be calculated? This question was important in the earlier years. In 15, 16, 16, 17, 17, 18. That time this question was relevant. When will net worth be calculated? If you ask me today, when will net worth be calculated? We have to take the last date of the previous year and it should be an audited financial statement. But in the earlier phase 1, phase 2, this important discussion was relevant. So let us read. Taken from your study material, net worth will be calculated in accordance with the standalone financial statement of the company. So that we have already discussed. And when will you take the net worth? If it is an existing company, then we'll take the net worth on 31st March 2014. And if the net worth on 31st March 14 exceeds 500 crore rupees and it is a listed company, then it will become applicable. Or if it is an unlisted company but the net worth is more than 500 crore on this date, then also Ind AS will become applicable to you. Or the first audited financial statement for accounting period which ends after that date. Or we can take the net worth on first audited financial statement for accounting period which ends after that date, means we will take 31st March 15. We can take 31st March 15 also, or any other date between these two dates. Suppose a company may not have 31st March as year ending date. Okay, if its year ending date is 30th June, then I can take 30th June also. And then what about companies which were not in existence on 31st March 14? Possible? The company was incorporated on 1st April 14. So then this you can't apply. Then I will apply this one. For companies which are not in existence on 31st March 14 or an existing company, or suppose it was not fulfilling the threshold of net worth on this date, then existing company under any of the threshold specified in Ind AS applicability threshold above for the first time after 31st March 14. So any time you may fall after 31st March 14, the net worth shall be calculated on the basis of the first audited financial statement ending after that date in respect of which it meets the threshold specified. So if suppose a company meets net worth criteria on 31st March 15, then also it will start applying Ind AS. And Ind AS first phase is 1/4/16. If its financial statement meets the requirement on 31st March 16, then also it will start applying from 1/4/16. Earlier there used to be a question, can we apply voluntarily Ind AS before 1/4/16? The answer is no, because in India the Ind AS will become applicable only from 1/4/16. But this question after so many years have become useless now. But when this Ind AS was introduced in India, that time some companies thought, can we apply in 14/15 itself or 15/16 itself? The answer is no. You can't apply before that date. Then what about NBFC? For NBFC I can't use the same date, because for NBFC the first phase itself is 1/4/18. So for NBFC they have said the net worth will be calculated as per standalone on 31st March 16, or the first audited financial statement for accounting period which ends after that date. Is it right? So if you meet the net worth criteria here or here, Ind AS will become applicable to that NBFC. But as on date, we have to just keep on checking every previous year ending date. And if it is more than 250 crore or it gets listed, the standard will be, Ind AS will become applicable. Now what about NBFC which are not in existence on 31st March 16? Then, or an existing NBFC which was not fulfilling net worth criteria here, the net worth will be calculated on the basis of the first audited financial statement ending after that date in respect of which it meets the threshold now. So this is about NBFC. For NBFC the net worth date is 31st March 16. For other than NBFC the net worth date was 31st March 14. If it doesn't fulfill on 31st March 14 or 31st March 16, then any next audited financial statement on which it meets the requirement, we are going to take that. Is it right? For applicability. Now come to next line, special cases. Wherever Ind AS are applied, then all entities in the family will apply Ind AS. The logic is consolidation will become easier. It means if A Limited applies Ind AS, then following entities will also apply Ind AS: subsidiary, associate, joint venture, parent, even LLP, because LLP is also consolidated, and even the partnership firm in which A Limited is a partner. For the purpose of consolidation, they will also prepare financial statement as per Ind AS. so that it can be consolidated with the parent company. So this is that example. Suppose we are accountant of X Limited, which is a subsidiary of Y and which has got one LLP, one associate, one partnership, one subsidiary and one joint venture. So Ind AS will become applicable to Y, which is a parent company, N, which is an LP, and X Limited is the designated partner, K Limited, which is the associate of X, P Limited, which is a partnership firm in which Y Limited is partner, Z Limited, which is a subsidiary of X Limited, and B Limited, where X Limited is a venturer. So it will, all these companies will have to apply Ind AS so that the consolidation can be done using same set of financial statement. Now your question was, what about banking or insurance company? NBFC I have discussed. If your subsidiary, associate or joint venture is a banking or insurance company, the problem will be that they are right now not required to follow Ind AS, but parent company is required to follow Ind AS. Parent will follow Ind AS. Bank, insurance will follow AS. But because it is a subsidiary, it will prepare one more set of financial statement so that the financial statement prepared on the basis of Ind AS can be consolidated by the parent company. So it will have to provide relevant financial data as per Ind AS for consolidation purpose. Okay. Now reverse case. Bank, insurance is a parent company, so they will follow AS, and subsidiary company follows Ind AS. So what will happen now? Subsidiary will prepare two financial statement, because always subsidiary will have to compromise. Remember, who will have to compromise? So subsidiary is like son, parent is parent. Who compromises? The son has to compromise. Father says do CA. Son wants to become a photographer. He is doing CA. Is it right? I wanted to become doctor. My father said CA. I became CA. I am subsidiary. So subsidiary will have to compromise and prepare financial statement in the manner parent desires. Now another interesting case is overseas company is a parent company. Will overseas parent company follow Ind AS if subsidiary follow Ind AS? The answer is no, because Companies Act applies to Indian companies which are registered under the Companies Act 2013 or 1956. So therefore they will not apply Ind AS. Reverse. Subsidiary is in foreign country, parent is in India and parent follows Ind AS. This subsidiary will prepare two financial statement now. One is as per respective standard of that country. For example, if it is a US subsidiary, US GAAP, and it has to prepare one financial as per, they will provide data as per Ind AS, so that this Ind AS financial statement can be consolidated by the parent company. So that way you have to remember subsidiary will compromise. What about banking company? RBI has postponed the implementation till further notice. What about insurance or insurers? IRDA has postponed till further notice. What about voluntary adoption of NBFC, banking and insurance company? I have written a small one-line note. They are not allowed to even voluntarily adopt Ind AS. What about companies which are listed on Small and medium exchange. Have you heard SME exchange?
Yes.
Not BSC or NSE. BSC, NSE is for big companies whose net worth goes into hundreds and thousands of crores. But if you want to raise funds in 2 crore, 3 crore through equity route, not through loan, then you can raise fund through SMEs. The answer is, even though they are listed on SME exchange, Ind AS is not applicable just because they are listed on SME exchange. Of course, if they fulfill any other requirement, then Ind AS is applicable. Whether it is applicable to real estate investment funds, very popular nowadays. That means, suppose you want to invest in a real estate, a 10 crore property. You know that its price will appreciate, but you don't have money, you have only 1 lakh rupees. So you can invest in this real estate investment fund. So they collect 1 lakh, 5 lakh, 10 lakh from lakhs of people, thousands of people, like mutual fund, but their specialization is investment in only real estate. It's like mutual fund units. Okay. And similarly, we have infrastructure investment fund. They are called InvIT. Okay, INVIT, InvIT, infrastructure investment fund. So they are also mandatorily required by SEBI to follow Ind AS, because public money and big time public money is involved. And mutual funds from 1/4/23 notified by SEBI will become, they will also follow Ind AS now. Slowly and slowly they will make more and more company follow Ind AS, and over a period of time that accounting standard will be removed from India. That is the plan, but that will take some more years. And then after a few years, maybe after 5 or 10 years, only Ind AS will remain. Is it right? So now we'll solve some questions taken from study material. All questions are from study material. Source write down study material, and this is a good question for exam purpose also. Following is a snapshot of audited balance sheet. So this is already audited, so no problem, of company on 31st March 14. Such a waste of time by asking such old outdated questions. Company A's equity shares are listed on stock exchange. So this is a listed company, and we have to check the net worth on this date. You have to check the net worth on this date. And is it an NBFC or other than NBFC? Other than NBFC. Is it right? So what is the balance sheet? Share capital we will take for net worth calculation. Securities premium I will take. General reserve. How much is general reserve in your book? Not given? Wait a minute. General reserve, write 150. Some typing mistake. This also I will take free reserve. Revaluation reserve will not take. P&L account will take, it's a free reserve. And then liability I will not take. Fixed asset, investment, current asset, this I will take as a negative number. So quickly tell me, what is the total of these items minus 80? What is the net worth you are getting? 160 plus 200 plus 150 plus 75 minus 80.
505.
Net worth is 505, and it is a listed company. So the net worth criteria was met on this date. Listing criteria was met on this date. As per roadmap, which phase company A will fall into? Phase 1. Because both conditions have satisfied for phase 1. If you look into your book, paragraph 7, company which are listed or in the process of listing and having net worth of 500 crore or more will come under phase 1 if their net worth on 31st March 14 is more than 500 crore. Will your answer change if the company is an unlisted company? So again you see in phase 1 it is written for unlisted company net worth should be more than 500 crore on 31st March 14 or any audited financial statement after that date. So this company will also fall under phase 1. Both answers are phase 1. Can you write the answer yourself? I have given the answer in the book. Then come to question number 3. This is continuation of question 2. Just make a small correction in the notes. If it is printed illustration 3, you write there, let us say in question 2. Let us say in question 2. It is written illustration 1, I think. So make it 2. I have just made some change in the order of the question. So suppose in question 2, the balance in the P&L account was minus 375 crore. Oh my God. Whether Ind AS, when Ind AS should be applicable to company A, will your answer change if the company is an unlisted company? So let me first check the net worth on the screen. Share capital, security premium, general reserve. This time this is minus 375 and miscellaneous expense minus 80. So please check the total of the institute. What is the answer? 55. It is a listed company is satisfied. Net worth should be greater than or equal to 500. Not satisfied. So first clause A is not satisfied. Then phase, so this answer will be not phase 2 because phase 2 because listed company can follow phase 2. Listed company can follow phase 2. So phase 2. Then suppose second question, it is unlisted company. For unlisted company, if it has to come under phase 1, the net worth should be greater than or equal to 500, not complied with. And for phase 2, it should be 250 crore or more, but that I don't know. So the answer will be depending upon year in which the net worth criteria is satisfied. You don't write phase 2 because for unlisted company, in phase 2 also the net worth should be 250. So 250 is also not satisfied. So therefore, it will be applicable in that year when the net worth criteria will be satisfied. Okay. So see the last line of the answer. If it is an unlisted company, Ind AS would not be applicable until it breaches the net worth criteria mentioned in the roadmap. So it may not be applicable for many more years because it is unlisted and its net worth is just 55 crore. From 55 crore to 250 crore is not easy, boss. 4 times you have to make profit. Okay. Or you have to raise funds of the difference. Making a loss of 375 crore, getting funding is also not easy. Okay. One student is asking only net worth criteria is applicable for Ind AS. The answer is net worth criteria and listing criteria. No other criteria is applicable for applicability. You are right. Turnover criteria is not applicable. Okay, any other query? Anybody, any query? Question number 4 from study material. The net worth of company B, first underline unlisted company, was 600 crore on 31st March. So for unlisted company, if it is 500 crore or more on 31st March 14, phase 1 will become applicable. So it will start falling Ind AS from 1/4/16. Ind AS will become applicable from 1/4/16. However, due to losses in FY 14-15, good question, the net worth is 400 crore on 31st March 15. Is it a relevant or irrelevant information? From when company B shall apply Ind AS? So it will apply from 1/4/16 because it was in existence on 31st March 14 and on 31st March 14 the net worth was more than 500 crore. Okay, so the answer is the company B will require to follow Ind AS for the accounting period on or after 1/4/16. Very good question. Some student can make a mistake here. Question number 5. The net worth of company C, again unlisted company, was 400 crore. On 31st March 14 net worth is 400 crore. The net worth was 600 crore on 31st March 15. From when will company B apply Ind AS? So either you meet on this date or any other date after that date, you will apply from 1/4/16, because you have to apply Ind AS only from 1/4/16 or thereafter. Don't write the answer 1/4/15. In India, the Ind AS became applicable only from 1/4/16. So your answer cannot be any date before 1/4/16. Even voluntarily you cannot apply before 1/4/16. So the answer is 1/4/16. Question number 6. Source study material, write down. Company D is a parent company of a group A. Company B is an unlisted company. A is an unlisted company. D is the parent company of a group A. A is an unlisted company having a net worth of 60 crore on 31st March 14. Following are the other companies of the group. Company B is an unlisted company. B is also unlisted. It is a subsidiary of A. So B is a subsidiary and its net worth is 600 crore. Then another company C, unlisted company. It is a subsidiary of B. Net worth is 150 crore. Whether Ind AS will be applicable to company A, B and C. So look at the question. This is a company whose net worth is more than 500 crore. So Ind AS is applicable to B. Once Ind AS is applicable to B, its parent company A and its subsidiary company C will also follow Ind AS. Is it right? So the answer is Ind AS would be applicable to all the three companies. One more question we'll take. Question number 7. Why 7? 6 we have done. Very good question. Write down important. Question 7 important. Question number 3 was important. 2 and 3 were similar. Following is the structure of company D. There is a company D. It has a subsidiary E. It has another subsidiary D. Two subsidiaries are there, E and H. This company E has a subsidiary F. This company E has an associate G. Company H has a subsidiary company H. Is it right? Are you following the group structure? All the companies in the above structure are unlisted company, and the net worth of company E is 300 crore. So where is E? This is E. It is 300 crore, and net worth of all other companies below 250 crore. To which company would Ind AS be applicable? So first you have to see, if I apply the applicability criteria, none of them are listed. Then I will apply the net worth criteria. So net worth of only E is 250 crore and above. So we are assuming phase 2 or thereafter, phase 2, okay. So 250, so it is applicable to E. Will it be applicable to D also? Yes, because D is the parent company. Will it be applicable to F also? Yes, because it's a subsidiary. Will it be applicable to G also? The answer is yes. So mandatorily 4 companies will follow Ind AS. E, D, F, G. But $1 million question is now whether H and I will also follow Ind AS. D is following Ind AS not because it fulfilled listed criteria or net worth criteria. D has followed Ind AS because its subsidiary follows Ind AS. So it is not having a net worth of more than 250 crore. It is not a listed company, but it is following Ind AS. Whether H will follow Ind AS, the answer is not mandatorily, but it will have to prepare 2 sets of financial statement. The reason is it is a subsidiary of D. D will follow Ind AS. Answer is printed in the book. D will follow Ind AS. So that means D will have to prepare financial statement based on Ind AS. Subsidiary will have to provide a financial statement based on Ind AS to its parent company so that parent company can consolidate. So it will have to voluntarily adopt Ind AS, or it has to prepare 2 sets of financial statement. Same thing here. This company I is a subsidiary of H. So even this subsidiary of a subsidiary is also subsidiary. We'll see in the consolidation chapter, because indirectly you are controlling I. So this will also, either it will voluntarily adopt Ind AS, is it right? Or it will prepare 2 sets of financial statement so that parent can consolidate. So some group companies, what they do, they ask these 2 companies also to voluntarily adopt Ind AS. The reason being, they won't have to prepare 2 sets of financial statement, but legally speaking, H and I are not mandatorily required to follow Ind AS. But practically, they will have to prepare financial statement based on Ind AS because it will be consolidated with company D. Is it right?
Not exactly like Corona.
Sometime even the neighbors catch Corona, okay? Who knows? Your family member may not have Corona, but neighbor can have Corona. It's like that. So this is the answer drafted by the institute. You can write your own answer in the exam in the similar way. One more question is there. Total 8 questions were there, right? These all 8 questions are in the study material. It says ABC Inc. incorporated in a foreign country has a net worth of 700 crore. So ABC is a foreign company. We don't have to look at the net worth of the foreign company. Is it right? It has 2 subsidiaries, X and Y. Net worth is 600 crore and 150 crore. Whether company X and Y should require to follow Ind AS from accounting period commencing on or after 1st April 2016 on the basis of their own net worth or on the basis of the net worth of ABC. The answer is very simple. You have to look at the standalone financial statement first of all, and secondly, Ind AS is not applicable to foreign company which are incorporated in a foreign country. They do not fall under Ind AS. So only X Limited, whose net worth is more than 500 crore on 31st March 14, this will follow Ind AS, and this is not required to follow Ind AS. Okay. Is the parent company required to follow Ind AS because one of its subsidiaries following Ind AS? The answer is no. Foreign company will not follow India's, right? Subsidiary will compromise, parent will not. So this is the answer of this question. Foreign company is not required to follow India's. Is it right? So that was about examples. Now we'll take a 5 minutes break. You can relax for 5 minutes. I am not stopping the video. Please wait for 5 minutes. Drink water, tea, coffee, whatever you want, but only for 5 minutes.
कट नहीं आता था रे ऐसा था रे ये यहाँ पे भी लगा देते हैं ये ऐसा लग रही है गंदा हो गया क्या कपड़ा दे नीचे कॉलिंग भी दूंगा आपको मेरे कॉलिंग वाटर है वही कॉलिंग कपड़े पे लगा रहा चलो ये कपड़ा ठीक है ना
Okay, we are back. Good evening again. Any query? Anybody any query? Please ask me the query. Now we'll come to next paragraph. Key matters on transition. Company was following accounting standard, okay, till a certain date, let us say 31st March 23. But then from 1/4/23, Ind AS will become applicable because the net worth exceeded 250 crore or it become a listed company. Now the question is, what will you do in the transition year, because you are following a different set of standard. Now you have to move to an altogether different set of standard which are quite different from each other. At so many places there is a difference. There are some situations when we don't have any accounting standard also, like we don't have accounting standard on agriculture, we don't have accounting standard on financial instrument, we don't have accounting standard on share based payment, we have one guidance note on ESOP. So, and there are other standard where there is lot of differences like revenue, leases. So how to deal with that? So that is called key matters on transition. And for the first time adoption of Ind AS, actually we have a standard called Ind AS 101, which is called first time adoption of Ind AS. Same discussion you will find in Ind AS 101 also. So this paragraph we will have to read 2 times, today and then in Ind AS 101. Okay. So as we discussed that, suppose it becomes applicable from 1st April 2023. So my first financial statement under Ind AS will be covering the period 1/4/23 to 31st March 24. This is called first Ind AS financial statement. But then you have to give a comparative financial statement. Comparative financial statement will be given for the period 1/4/22 to 31st March 23, and you have to also give in the first year when Ind AS becomes applicable to you one opening balance sheet starting on the first day of the previous or of the comparative period. So 1/4/22. So this is the opening balance sheet date. So basically this balance sheet you have to first bring as per Ind AS. Then whatever events and transactions have happened in this year will be adjusted in this balance sheet, and then this balance sheet will be used for preparing the first Ind AS based financial statement. So actually your preparation will start much before that, from 1/4/22. So you will have to first give a comparative financial statement. Second thing, Ind AS applicability. Companies to which Ind AS are applicable shall prepare its first financial statement as per Ind AS effective at the end of its first Ind AS reporting period. Oh my God, what is this? Understand. 1/4/23 to 31st March 24 is my first Ind AS financial statement. Understood? I am taking this date as an example. So you have to see which Ind AS is applicable on 31st March 2024. On this date, you see which Ind AS, which provisions are applicable. Which Ind AS and which provisions are applicable on the last day of the first Ind AS financial statement, and that Ind AS will be applied for comparative also. That Ind AS will be applied for opening balance sheet also, so that all the balance sheet, all the comparative are based on latest Ind AS applicability. Is it right? So including that 1/4/22, balance sheet will be based on the provisions and Ind AS applicable on 31st March 24. This paragraph is very easy. Consistent application of Ind AS. So once you start following Ind AS, either voluntarily or mandatorily, then it will follow Ind AS for all subsequent year, even if any of the criteria specified in the rules does not subsequently apply to it. Once Ind AS, always Ind AS. Okay. Once Ind AS, always Ind AS. Once an Indian, always an Indian by heart. Okay, you can't change an Indian. You can take Indian out of India, but you can't take that India out of an Indian. Is it right? True or false? Same thing for Ind AS also. The next is Ind AS will be applied for both standalone and consolidated financial statement. Applicability will be checked on the basis of net worth as per standalone financial statement. But once it is confirmed that Ind AS is applicable, and if the company is preparing CFS, then it will also apply to consolidated financial statement also. Next paragraph I am going to read at the speed of bullet train. Okay, agreed? Say yes.
Yes.
Relevant section referring to Ind AS in the Companies Act 2013 and rules. So basically it's a good compilation of which section of Companies Act have an influence on the accounting and financial reporting, although it is not a part of our accounting syllabus. So one is section 2, subsection 2, states that accounting standard means the standard of accounting or any addendum thereto for companies or class of companies referred to in section 133. So section 2 says accounting standard means go to section 133. Okay. That is why I don't teach law. They should not have given this section only. Now, what is the requirement? So if you have to shift to 133 only. So section 133 states that central government may prescribe the standard of accounting or any addendum thereto as recommended by Institute of Chartered Accountants of India, constituted under section 3 of the Chartered Accountant Act 1949, in consultation with and after examination of the recommendation made by the NFRA under the power given to central government under section 133. It has notified the company Indian Accounting Standard Rules 2015. So this we have started our chapter with these rules only. It was notified by central government given under 133. Then section 139 suggests that financial statement shall give a true and fair view of the state of affair of the company or companies, comply with the accounting standard under 133, and shall be in the form or forms as may be prescribed for different class or classes of companies in schedule 3. So that is about presentation of financial statement. After this we are going to take another chapter which is schedule 3 only, and we are going to solve again some numerical question. Then there is a section 135(5)(a), a statement that applicable AS have been followed with proper explanation relating to material departure shall be given in the director's responsibility statement. This I will explain. In the annual report you will find there is a director's responsibility statement, and the directors will have to mention whether they have departed, that means deviated from an accounting standard, an explanation of that and why they had to deviate, to be issued under section 134(3)(c) in the director's report, which is published in the annual general meeting. Then section 143 you have studied in auditing also, that auditor has to opine whether financial statement comply with accounting standards. Then section 233 is power to compromise or make arrangement with creditors and members. I don't know what is accounting to do with that. Anyway, my job was to read because I can't explain section 230. Sorry, you can ask for 10 rupees refund. More than that I can't give. Section 232, mergers and amalgamation of companies. The scheme of compromise or arrangement is to be sanctioned by the tribunal only after obtaining a certificate from company's auditor that accounting treatment given proposed in the scheme is as per accounting standard mentioned in section 133. So section 133 is important for most of the restructuring that they propose. Then section 66, you have studied internal reconstruction in your intermediate course. That is called reduction of share capital. That no application of reduction of share capital will be sanctioned by the tribunal unless the accounting standard proposed by the company for such reduction, accounting treatment, is in conformity with accounting standard prescribed in section 133 or any other provision of this act, and a certificate is given by the auditor to the tribunal. Is it right? So these are the section affecting our accounting treatment and presentation of financial statement. And then there are some SEBI rules and regulations also. So SEBI basically deals with listed companies, and they have given the format for listed company because listed companies are required to prepare quarterly reports. Is it right? But the accounting treatment in the quarterly report will also be as per Ind AS. Format will be as per SEBI. Format is as per SEBI. So you will see nowadays, because the quarter has ended, you will find lot of quarterly reports coming in. If you have subscribed to any company share, on the email they will send you the quarterly performance of that company. Is it right? So SEBI in its circular dated 30th November 15 amended the format for publishing quarterly financial statement, because Ind AS was introduced around that time. So they changed the format of quarterly financial statement. Point 5 of this circular clarified that companies adopting Ind AS while publishing quarterly or annual result under regulation 33 of listing regulation shall ensure the comparative filed along with such results are also Ind AS compliant. So even the comparative will be as per Ind AS. Next is clarification regarding applicability of Ind AS to disclosures in offer document. Whether Ind AS is applicable to disclosures given in offer document under SEBI ICDR regulation 2018. So it was there in the law syllabus, but law is not there in the new course. So probably in your life you will not see the ICDR regulation, those who are in the new course. So now if you are giving, suppose prospectus where you are giving 3-year financial data, those 3-year financial data will also be based on Ind AS. Is it right? Then next is revised format for financial result and implementation of Ind AS by listed entities. For the period ending on or after 31st March 17, that is your first Ind AS year ending date. Do you remember? First Ind AS was ending on 31st March 17. Easy to remember the date because Ind AS became applicable from 1/4/16. The format of unaudited or audited quarterly financial statement, that is statement of profit and loss, unaudited and audited half yearly balance sheet, to be submitted to the listed entities by the listed entity with the stock exchange shall be as per the format of balance sheet and P&L account, excluding notes and details of classification as prescribed in Schedule 3. So the financial statement submitted to stock exchange will be as per Schedule 3. Financial statement submitted to stock exchange will be as per Schedule 3, but this is not applicable to banking and insurance company, because in India banking companies follow a different format. Some of you may have studied in your intermediate also. Similarly, there is a different format for insurance company also. So they will give in that format. So if you really speak, your main chapter is over here, but there is some discussion of accounting standard also. Some students have a wrong idea that accounting standards are not applicable in India. Accounting standards are very much applicable for those companies which are not covered by the roadmap. That means, suppose if it is not a listed company, its net worth is less than 250 crore, it is not a subsidiary, parent, associate, joint venture, partnership, LLP of a company which follows Ind AS, then Ind AS is not applicable. If you are a banking company, Ind AS is not applicable. If you are an insurance company, Ind AS is not applicable. If you are NBFC, which is unlisted and net worth below 250 crore, Ind AS is not applicable. So out of 13 lakh registered companies in India, something around 50 to 60,000 company may follow Ind AS, considering all those subsidiary, associate, joint venture. Still 12 lakh companies will still follow accounting standard. In your offices, there are so many private companies, am I right? And their net worth is less than 250 crore. Which standard do you apply? Accounting standard. So they will continue to follow accounting standard notified under Rule 2006. So banking company, insurance company, unlisted company, net worth below 250 crore, and non-companies means partnership, LLP, individual, cooperative society, NGO, they are still going to apply accounting standard. Okay, one example I will take. A Limited, an Ind AS company, B Limited, AS company are partners in AB and company. Oh my God. One Ind AS company, one accounting standard company are partners of AB and company. Then what about AB and company? Will it apply AS or Ind AS? Ind AS. Because if a company is a partner in a partnership firm and company follows Ind AS, partnership firm will also follow Ind AS. But suppose both are applying accounting standard only. Both partners are applying accounting standard, then the firm will also apply accounting standard. Next paragraph is applicability chart of accounting standard, homework. You will find there is a long list. The companies which follow accounting standards are divided into 4 levels. Level 1, level 2, level 3, level 4. Is it right? Some accounting standards are applicable to all of them. Some companies are exempted from certain accounting standard. Okay. And some standards are exempted for certain paragraphs for certain companies. Impossible to remember that chart. Okay. You can try. But still you can try on your own. So you refer applicability chart. Some standards are fully applicable to all of them. Some are not applicable to some of them. Some are partially applicable to some of them. As you move from level 1 to level 4, exemptions increases. Is it right? Level 1s are usually the bigger companies. Now, I have added one paragraph from my side also. How IFRS is different from accounting standards. Not a part of syllabus. The question was why we have adopted why we have converged to IFRS. What is the extra thing we are getting in our IFRS which was not there in our accounting standard? So I have summarized it in the following way, that IFRS standards are principle based, not rule based. Principle based means they will give you a principle. For example, they will say if lease term covers major part of economic life of the asset, it is a finance lease. But what is major part is a matter of judgment. Whereas in US GAAP, which is a rule based standard, they will say if the lease term is 75% of the economic life, then it is a finance lease. So that means you are not left with any judgment. They are giving you exactly how to check this or that. But here in IFRS or Ind AS, it is a principle based standard. Okay. In IFRS there are more judgments. In US GAAP there is less judgment. Then IFRS is more focused on reporting, because the purpose is that financial statement should be used by the investor and make investment decision. The focus is not on accounting. Next is, it is applicable to separate as well as consolidated financial statement. Under old GAAP, consolidated financial statement was not mandatory. It was only mandatory under Companies Act for some companies. But now it is mandatory for all companies. Some exceptions are given in Ind AS 110, which I will tell you at that time. Why IFRS is very important set of standard? It gives more and more importance to substance over form. Okay, example, and because of that our accounting will change substantially. What you have learned till intermediate stage, you'll have to change it now. Like for example, goods are sold on extended credit terms, means more than normal credit period. Buy now, pay after 3 years, 1500 rupees. What is the entry you will pass now? If you are a student of 12th standard, foundation, intermediate, you will simply say debtor account debit to sales account 1500. Is it right? But if you are an Ind AS or IFRS student, you will say we will first calculate the present value of that. Say present value comes to 1050. So I will book the sale amount 1050 and then I will calculate interest on opening balance every year and treat it as finance income or finance expense. If you are a seller, finance income, but if I am buyer, I am actually paying interest. Oh my God, that is substance over form. So therefore, if you find that there is a delay in making or receiving payment beyond 12 months, and if the financing component is substantial, then we will have to account for finance income or finance cost as a separate item. I will explain to you in detail the same example under Ind AS 115 revenue. Okay, not today because same thing will come in your syllabus. Then next example is the same example, goods are sold for 100 rupees for 3 months credit, then it is okay. But if our goods are sold at 110 for 15 months credit, you are charging 10 rupees more for giving extra credit. So it simply means you are charging 10 rupees as interest income, substance over form. One more great change that will happen is Ind AS and IFRS use fair valuation more and more, and therefore you have to learn importance of time value of money. In our syllabus you should know how to calculate present value, how to calculate IRR, how to discount the future cash flow. All this will be required in almost every chapter because we need to find out the fair value. Next is, because of Ind AS, the disclosure requirement will increase now. Investor require more and more information. Investor also wants to know what are the assumptions made by the management that you have to disclose. As we started that, there were a lot of scams, scandals. The reason is that financial investors don't have enough information. Now the financial investor will have same information which management has because of the extensive disclosure requirement, and because of that they can take a more informed decision. They can understand that there is something wrong in this company. They can understand that yes, something is going to wrong, something bad is going to happen with this company by looking at the disclosures that they have made. Is it right? More and more role of judgment and estimates have increased because lot of provision requirement is to be done. US GAAP is not in our syllabus, so please enjoy. US GAAP is more rule based. If you pass US GAAP, you will get CPA qualification, which I have got, certified public accountant, which is equivalent to chartered accountant in India. CPA exams are also held in India also, but don't try now. First you pass the C exam and then you can easily crack CPA exam also, because there are only 4 papers, no articleship. Only 4 papers, no grouping system, individual 75 marks, and you pass that paper. It requires less judgment because most of the things are defined in the US GAAP. Now, if there is a conflict between law and Ind AS, law says one thing, Ind AS says other thing. For example, Schedule 3 requirement may be different from the disclosure requirement under other standards. Which one will prevail? Law will prevail. So, provision of the law will prevail, and the financial statement has to be in conformity with the law. Next is comparative statement of International Accounting Standard and Ind AS. So these are the standard under IAS or IFRS and the corresponding standard under India. Is it right? So I will not read it and bore you. You can just read on your own. This is our syllabus. Only I will tell you what is not in the syllabus. Ind AS 1, 2, 7, 8, 10, 12 are in the syllabus. 16, 19 are in the syllabus. 20, 21 is in the syllabus. 23, 24 are in the syllabus. 27. But this IAS 26, as we said, right now in India we don't have a corresponding standard. So enjoy. Then 28, 29 is applicable. 32, 33 is applicable. Then there was Ind AS 29 also in your book, not applicable. Ind AS 29 in your book, not applicable in your syllabus. 34, 32, 33, 34, 36, 37, 38, 40, 41 are applicable, and after this the numbering will change, because after that IFRS 1 started getting issued. So my numbering system will become Ind AS 101, 100 plus 1. You will ask, what about 42 to 100? There is no standard between 42 to 100. Then 102, share based payment applicable. 103 is applicable. 104 is not applicable, not printed in the notes also. 105 is applicable. 6, 7 is applicable. 8, 9 applicable. Then Ind AS 10, 11 applicable. Ind AS 12, Ind AS 13, 113. Ind AS 14 is not applicable in syllabus. Please cancel. And Ind AS 115 is very much applicable. 116 is applicable. Good news, 17 is not applicable. Okay. So except which standard? 29, 114, 117. 117 is any case draft, it's not finalized. Remaining are applicable in your syllabus, and that will be my agenda from tomorrow onwards. First I'll take schedule 3 and then other standard. So next point is total reporting standard issued are 41 under IFRS. But in India, the reporting standard issued are 39. The 26 is not yet issued and 117 is not yet issued. Then IFRS 17 and IAS 26, I have told you, are not yet notified in India. Then total interpretation are 18 under IFRS, but total interpretation under Ind AS are 17. So how do you reconcile 18 and 17? There are two standards, two interpretation which are not applicable in India. IFRIC 2 and SIC 7, but plus 1, there is one appendix which has been added in Ind AS 103. So 18 minus 2 plus 1. These are interpretations. 18 is in IFRS. In India, these two are not there, but this is added from our side, that is Carvin. So 17 interpretations are there. How Ind AS have been numbered? Now tell me, if it is IAS 1, it will be Ind AS 1. But if it is IFRS 1, then it is given number as Ind AS 101. So if IFRS, I will take 100 plus the number given in IFRS. If it is IAS, I will give the same number. So we have tried to maintain the same numbers, same paragraph number also. Is it right? Paragraph by paragraph also we have kept it same. Only if a paragraph is added, then one paragraph is added at that point. And if a paragraph is removed, we have written omitted, so that the paragraph number also matches. Now, how Ind AS have been structured? So normally any standard will have following sequence. First they will give objective, then they will give you the scope of the standard, where it is applicable or not applicable. Then they will give you the definition of important terms. The fourth part is the main part, which is the content of the standard, where all the provision of the standard will be there. Usually the standard will end with a disclosure paragraph, and sometimes there may be transitional provision also, like in Ind AS 116 leases, how to transit from old lease accounting to new leases accounting. If there is any amendment in the Ind AS, you are following some other Ind AS, now it has been completely amended. So how will you shift from old version to new version? That is transitional provision, and the effective date of transition is given. And in some standard we have appendices. In IFRS they are called interpretation. In Ind AS it is appendices. Okay, so this is how they have been structured. Question number 9, note down homework. Question number 9 is from RTP May 2022. Mark it important. RTP May 22 means it was asked in one of the ICI publication. Now I am just going to ask you two simple MCQs. Okay, on the screen. No need to write. It's so simple, no need to write. Or if you want, you can take a photo. Companies covered in phase 1 should have net worth. Option A, equal to 500 crore, equal and more than 500 crore, less than 500 crore, more than 250 but less than 500. So student who are learning at home will also reply. In the old course MCQ was not there, but in the new course they have said they will ask MCQ. So I am expecting the answer from student who are either attending online or on the YouTube. What is your answer? A or B or C or D? I have started getting answers. Let us see. B is the right answer. It should be equal to or more than 500 crore. So see how they will play with the words. You remember only 500 crore. Whether it is equal to or only more than, keep in mind. One more last question today, and this chapter will be over. Ind AS will apply to. Answer please. Everybody. Ind AS will apply to both consolidated as well as standalone. Only consolidated, only standalone. Optional. Wow, optional. So what is your answer? Everybody. Student at home. Student on YouTube channel if you are watching. Okay. So the answer is, maybe there is a time lag, so I get the answer a little late. A is the right answer. Yes, you are right. Mr. Anup, you are right. A is the right answer. So with this, thank you very much. This wonderful chapter, applicability of Ind AS and certain aspects we have covered. Question number 9 is your homework. See you tomorrow at the same time. Good night. All the best.